Hello everyone and welcome to our comprehensive analysis of financial instruments in the Indian market. I am Mehtab Singh and today I'll be walking through a detailed comparative study that we have conducted as a part of our FIN 214 course project. This presentation has been developed by Mehtab Singh, me and Saksham Tandon from Lovely Professional University and represents rigorous research and analysis. We're excited to share our findings with you today and we believe this analysis will provide valuable insights for investors across different risk profiles and investment horizons. So, how did we do this analysis? Let me explain our approach. We looked at 5 years of historical data. Now, you may ask, why 5 years? Because it covers different market conditions, good times, bad times, and everything in between. We've got our data from three trusted sources: NSE for stock market data, AMFI for mutual fund information, and RBI for government securities. Now, what did we analyze? Six things. One, risk levels. How risky is each option? Two, returns. How much money did they make? Three, liquidity. How easily can you sell them? Four, taxes. How much tax will you pay? Five, who should invest? Which investor type suits which instrument? And six, regulations. What rules protect your money? This way, we're not just looking at returns, but the complete picture of each investment. We picked three investments that represent different risk levels. First, Power Grid Corporation, a stock. It's a Nifty 50 company. It's stable but still carries moderate risk because it's equity. Second, Canara Robeco Mutual Fund. This invests in both large and mid-sized companies, also moderate risk but diversified across many stocks. Third, state development loans. These are government bonds issued by state governments. Very safe and very low risk. Now you may ask, why these three? Because we wanted to cover everything from safe investments for conservative people to growth options for aggressive investors. There's no one size fits all in investing, so we analyze the full spectrum. Now, let's talk about Power Grid first. Power Grid is India's central transmission utility. Basically, it manages the electricity highways of India. When power is generated anywhere in the country, it travels through the power grid network. The numbers are impressive. They control 90% of the interstate transmission. That's almost a monopoly. They operate 1.71 lakh circuit kilometers of lines and manage assets worth over 50,000 crores. Plus, it's in the Nifty 50. Why is this good for investors? I'll give you four reasons. One, monopoly position. Very few competitors can enter this business. High entry barriers mean stable business. Two, low volatility. Volatility. It's a utility stock. People need electricity in good times and bad times, so the stock doesn't swing wildly like the tech stocks. Three, high dividends. Power Grid pays 5 to 7% dividend yield every year, so you get regular income while your investment grows. 4. Growth potential. India's power demand is growing. More consumption means more transmission needed. Power grid benefits directly. So, overall, you get stability, income, and growth. A rare combination in equity markets. Now, mutual funds, specifically Canara Robeco Large and Mid Cap Fund. This fund invests 65 to 80% in large cap stocks, your TCS, Reliance, HDFC Bank type companies. The remaining 20 to 35% goes into mid cap stocks, smaller companies with higher growth potential. Now, why is this smart? Large caps give stability, mid caps give extra growth. You get both. The fund holds 50 to 70 different stocks. So if one company has a problem, it's only 1 to 2% of your money, not everything. That's the power of diversification. The fund manager has 15 plus years of experience and manages over 15,000 crores. That experience matters when markets crash or surge. Three big benefits here. One, balanced exposure. Growth from mid caps, safety from large caps. Two, consistent performance. The fund has performed well across different market cycles, not just in bull market. Three, accessibility. You can start with just 1,000 rupees per month through SIP. You don't need lakhs to invest in a diversified portfolio. The allocation is roughly 65% equities, 25% cash, and 10% others. Professional management, automatic rebalancing, and you don't have to track 70 stocks yourself. Finally, state development loans, the safe option. SDLs are bonds issued by state governments to fund infrastructure, roads, irrigation, power projects, usually 10-year maturity. Market size is over 1.5 lakh crores. These come with AAA ratings, the highest possible rating. Near sovereign security means they're almost as safe as central government bonds. Look at the credit quality. 85% are AAA rated, 15% are AA rated, no defaults in history. Four key points about HDLs are: 1. Better yields. They pay 40 to 60 basis points more than central government bonds. On 10 lakhs, that's 4 to 6,000 rupees extra per year. Better returns, same safety. 2. Capital preservation. Your money is safe. Fixed payments, guaranteed returns, no volatility like stocks. 3. Funding state development. Your investment helps build infrastructure in states. 4. Benchmark for other bonds. Many state backed companies price their bonds based on HDL rates. Now, for retirees, for conservative investors, for anyone who wants to balance a risky portfolio, SDLs are excellent, better than fixed deposit, safer than corporate bonds. Now let's compare the risks. Power grid. Moderate market risk, volatility of 26.43%. This means the stock price can swing up or down roughly 26% in a year. But compared to other stocks, this is actually low. Most stocks are much more volatile. Canara Robeco Fund. Also moderate risk, but because it invests in stock, but it's spread across 50 to 70 companies. So if one company fails, it barely affects you. Diversification reduces risk. SDLs, low risk, mainly interest rate risk. If rates go up, bond prices go down temporarily, but credit risk is minimal. You'll get your money back at maturity. Here's the key takeaway: there's a risk ladder. Equity has highest risk, highest potential returns. Mutual funds are in the diversified equity. Debt has the lowest risk, lowest returns. Your choice depends on your age, your goals, and how much risk you can handle. A 25-year-old can take more risk, a 65-year-old retiree cannot. Understanding this is crucial for smart investing. That concludes my section of the presentation, where we have established the foundation, the methodology, the instruments we have selected, and critically the risk framework for understanding these investments. Now I'll hand over to my colleague Saksham, who will walk you through the next crucial elements of our analysis: the actual performance numbers, liquidity characteristics, tax efficiency, and most importantly, how to strategically allocate these instruments based on different life stages and investor profiles. Saksham, over to you.
So, good morning, all of you. As my teammate Mehta has told us about the risk management of these three instruments, now I will tell you about the historic returns of these three instruments. The power grid have the equity, known as equity, have the 5-year CAGR of about 25.96%. That is about the capital appreciation. Our stock price grows from rupees 95 to 310. That delivers 226% absolute return. The dividend yield consists about 5 to 7% dividend yield enhance total results. Moving further, the Canara Rebecca Bank mutual funds, known as mutual funds, that 5-year CAGR have the total growth of about 17.07%. That the diversified exposure of about portfolio 50 to 70 quality stocks delivered, that is about 133% absolute returns. Lower volatility, that direct equity with the Sharpen ratio of about 1.42%. Moving to the state government debts, that about the 5 years average yield, that is about 7.19%. Non-souvenir security with zero default histories. The predictable returns with semi-annual coupons. In this, we have seen that the return hierarchy is much higher in equity as well as mutual funds and less than government debts. Moving further, the liquidity and investment horizons. We will compare the liquidity level of both these three instruments. For the equity power grid, the liquidity is very high. Active NSE trading with tight spread of about 0.05 to 0.10%. Moving further, the mutual funds. The liquidity of the mutual funds is very high, T plus 2 settlements with NAV based redemptions. Moving further, the SDLs. The liquidity is very moderate. The secondary market trading with spread of about 0.20% to about 0.40%. The ideal holding period of about these three levels, the equity levels you can hold of about 5 to 10 years. That is a long term investment that horizons for compounding benefits and volatility smoothing. Recommended strategies: buy and hold for the longer period of time. Moving further, the mutual funds, you can hold it above more than 5 plus years. Minimum horizon to absorb market prices, cycles, and benefits for the rupee cost averaging. The recommended strategy for this is systematic investment, or known as SIPs. You can make the SIP as per your own demand. Moving further, the SDLs. You can hold it about 3 to 10 years. Hold until maturity, its predictable income and capital protection. The recommended strategy for this is landed portfolio with staggered maturities for liquidity. When your SDLs will be mature, you can take your money back and invest in different other sources. Next is about taxation framework. How taxation works in all three levels. Equity shares. The LTCG is 10% above 1 lakh. The holding period is 12 plus month for LTCG qualifications. The tax efficiency is very high. Flat 10% rate is favorable. No indexation benefits but significant exemption limited. Moving further, the equity mutual funds. The LTCG is same as 10% above 1 lakh. The holding period is also same 12 plus months for equity treatment. Tax efficiency in this is also high. Parity with direct equity of funds is less than 35% equity have different treatments. State development tax loans. Tax treatment slab is depends on the slab as per income tax. Holding period any duration. Always taxable. Tax efficiency low. No special rates for those in 30% tax slab bracket. Post tax yields is only 5%. Moving further, the market trend confirms our analysis. For the power grid trend, the observation: clear upward trajectory with moderate volatility. The interpretations: growth aligns with 25% CAGR. Short-term fluctuations confirm that 26.43% volatility. Implications: validates defensive equity positionings. Moving further, the Canara Robeco NAV. We can observe that it is a smooth, consistent upward movement with lower fluctuations. Interpretations: diversification and active management delivers 17.07% risk adjustment returns. Implications: confirms professional management effectiveness. Next is the state development loans yield range. We can observe that it is a stable yield with a narrow range reflecting rate cycle. Interpretations: stability supports about 7.919% average yield. Fluctuations are policy driven, not credit driven. Implications: validates near souvenir security status. Next, the strategic allocation for every life stages. There are three life stages in which we can be allocated the strategies that how we can invest our money. So we can take a rupees lump sum amount of 10 lakhs for each the life stages. For senior citizens, the age is about 60 plus years. That focuses on capital prevention and regular income. Priority: stability over growth. So in which the equity is about 15%, mutual funds is about 25%, and debt is about 60%. So in this we can be invest our money by this following. For debt, we can invest 6 lakh rupees for stable income and capital protection. For mutual funds, we can invest 2.5 lakhs that be for diversified growth, and equity lump sum of 1.5 lakh for divided income. Moving further, aggressive millennials, that age gap between 20 to 35 years, that more focuses on maximum wealth creation and growth. The priority of them are long-term capital appreciation, for which the debt is about 10%, mutual funds is about 35%, and equity is about 55%. Equity, 5.5 lakhs for high growth potentials. Mutual funds, 3.5 lakhs for diversified exposures, 35%. Debt is about 1 lakh for stability buffers. Moving further, middle aged families. The age gap between is 35 to 50 years, that focuses on about balanced growth and family securities. Priority, wealth creation with protection, in which we can say the debt is about 25%, equity is about 30%, and mutual funds is about 45%. For the mutual funds, we can save up to 4.5 lakh for core growth engine, for equity 3 lakhs for direct equity exposures, and for debt is 2.5 lakh for stability and goals. Moving further, the strategic takeaways: core fieldings, no universal instruments, each serve different needs in an investor's journey. Second, diversification is essential, mitigates risks and smooth returns across market cycles. Third, personalization is the key. Allocation must align with individual financial goals. We can say that you have to analyze before investing. You have to read each and every key steps before investing in a particular company, whether it is equity, debt, or mutual funds. The success formula is sustainable financial outcomes. You can be informed decisions, data analysis, and personalized pairing. The investment principles are dependent on three types: equity for growth, mutual funds for balance, and debt for stability. For the action call, build portfolios, not single instrument bets, and diversification across asset classes is proven path to sustainable wealth and creations. That's all from us. Thank you and have a good day.